Hello, dear friends. How all of you are? Okay. So, dear, in this video, or not a video, basically, in this live stream, we are going to discuss with you guys the detailed analysis of CA Final May 2025 RTP of direct tax, which has been issued by ICA. Although, dear, we have already shared the Hindi and English mix version of this RTP analysis, and you can find that video in our channel. But as some of the students were demanding the complete English version, so in this live stream, we are going to have the complete English language analysis of this mid 2025 RTP. Okay. So, dear, we are planning to bring more and more English language content if there is a requirement from you guys. So, if you guys really want that we should come up with more English language or 100% English language content, then you must make us aware so that we will know that there is a requirement of English language content as well. Okay. So, before moving, this RTP is May 2025 RTP, and as you guys know that very few days remains for your CA final exams, so we won't take much of your time, hardly or maximum 1 hour. In 1 hour, we will try that we will finish the entire RTP with proper analysis also. Okay, so without taking much of your times, we are starting with the RTP analysis. This is the case scenario one. Mr. Devansh is an Indian citizen and a person of Indian origin who is living in UK for the last 15 years. So he is living in UK for the last 15 years. Okay. But one important thing is that he is the citizen of India as well as the person of Indian origin. Okay. He comes to India every year for 1 month. Dear friends, if Mr. Devansh comes to India for only 1 month, then the period of stay of Mr. Devansh is just 30 days or 31 days in India every year. Are you guys getting? So, to constitute a resident, the period of stay in India must be 182 days or more in the relevant previous year, or 60 days plus 365 days requirement. Are you guys getting? But in this case, Mr. Devansh is coming India, no doubt, but just for 1 month. It means the total period of stay of Mr. Devansh in any particular year is not exceeding 31 days. Okay, so he is not. So we cannot consider him as a resident under first condition as well as under second condition, because to be a resident as per the first condition, you must have to be in India for a total period of 182 days or more in the relevant previous year, and to constitute as a resident as per the second basic condition, you have to be in India for a total period of 60 days or more plus 365 days or more in the preceding 4 previous year. But Mr. Devansh is not satisfying any of the conditions, hence he would be treated as an R, non-resident. Are you guys getting? Are you guys are with me? So Mr. Devan should be non-resident. But sir, before moving further, you are omitting one thing. I say what? There is a concept of deemed resident as well. A person can be considered as a deemed resident in India even if he has not visited India even for 1 day. It means even if the period of stay of that person is not even 1 day, is not for even 1 day in India. So to constitute deemed resident, there are certain important conditions which are needed to be satisfied. The very first condition is that person should be citizen of India. Person should be citizen of India. Second condition is he should not be liable to pay tax in any other country or territory outside India because of his residence or domicile. Means no tax outside India. As well as the third very important condition, his income other than income from foreign sources should exceed 15 lakh in the relevant previous year. Are you guys getting? So in this case, although Mr. Devansh is the citizen of India, so the first very basic condition is satisfied. But since he is living in UK and there is no data in this case scenario which is saying that in UK Mr. Devansh is not liable to pay tax, hence we cannot consider that he is not liable to pay tax in UK, and because of this condition we cannot consider him as a deemed resident. And since Mr. Devansh cannot be treated as a deemed resident, hence he would be considered as a resident. Okay, hence he would be considered as a non-resident. Okay, sir, say Mr. Devansh has been considered as a deemed resident, then whether he would be considered as a ROR or NOR. Dear, always remember, in case of a deemed resident, the person, the associate, would always be considered as a NOR. Okay, I hope you guys remember these things. Then one thing is for sure that Mr. Devansh is a non-resident. Now we won't take much of your time. Okay, we are directly moving towards the questions. What is the tax liability of dividend income of Mr. Devansh during the previous year 24-25? Ignore surcharge and cess. Dear, recall me. In case of a non-resident, since Mr. Devansh is a non-resident, the dividend income is taxable under section 115A at the rate of 20% gross basis. In case of a non-resident, the dividend income is taxable at the rate of 20% gross basis without allowing any deduction. But if that dividend income is from a unit in IFSC, then the rate of tax would be 10%. Are you guys getting? Okay. So here, if you read in the question, he has invested in the shares of Alpha and Beta and Delta in convertible foreign exchange. Alpha and Beta are the companies incorporated in IFSC carrying on the business which has been approved. Okay, Delta is a company incorporated in New Delhi. It means that Alpha and Beta are the units located in IFSC, and if Devansh gets any dividend from these entities, Alpha or Beta, and if Devansh gets any dividend from Alpha or Beta, then such dividend would be taxable at the rate of 10% in the hands of Mr. Devansh. But if the dividend income is from Delta, then such income is going to be taxed at the rate of 20% gross basis. Are you guys getting? Okay. The dividend income of Mr. Devansh from Alpha and Beta are 62,500 and 87,300. Then the total income of Devansh from then the total dividend which has been received by Devansh from the units located in IFSC is 149,800. 149,800, and the rate of tax would be 10%. Means the tax liability of Mr. Devansh from the dividend income from the units located in IFSC, means Alpha and Beta, would be 149,800 at the rate of 10%, means 14,980. I hope you guys are getting. And any dividend from any other unit not being a unit located in IFSC, such dividend is going to be taxed at the rate of 20%. In this case, Mr. Devansh has received dividend of rupees 21,800 from Delta, which is not a unit located in IFSC. Hence, in this particular dividend income, the rate of tax would be 20%. Then the tax payable would be 4,360. Means the total tax. Means the total tax payable by Mr. Devansh on the dividend earned would be 19,340. Okay. Moving ahead, what is the tax liability of interest income of Mr. Devansh from loan to Gamma, ignoring surcharge and cess? Dear, if you move forward in the case scenario, Mr. Devansh has given foreign currency, means Mr. Devansh has given foreign currency loan equivalent to 50 lakh to Gamma, incorporated in IFSC on 1st April 2021. The rate of interest is 10%. Okay, means Mr. Devansh is a non-resident. A non-resident has given foreign currency loan to a unit located in IFSC, and he is earning interest on that loan. Means a loan has been given by a non-resident to a unit located in IFSC. So as per section 1015, any income by the way of interest payable to non-resident. Sir, how non-resident? The IFSC unit which has borrowed money from Mr. Devansh is going to pay interest to Mr. Devansh, who is a non-resident in India. So so for Mr. Devansh, it is the interest income which he has received for the loan he has given to the IFSC unit, and so any income by the way of interest payable to Mr. Devansh by a unit located in IFSC for a money borrowed on or after 1st September 2019 shall be exempt. And here the loan has been given on 1st April 2021. So this interest income would be exempt in the hands of Mr. Devansh in India. So the tax liability would be nil. Okay. So if you move forward in the case scenario, okay, he has also made a deposit of foreign currency equivalent to 30 lakh in IFSC banking unit. Dear friends, if you have made the deposit in IFSC banking unit and if you are earning interest from that, then as per section 1015, interest on deposit on or after 1/4/2025 in an offshore banking unit is exempt. So again, the tax liability would be nil. Okay. What's the tax liability on dividend income of Gamma from fee during the previous year 24-25. Assume both the companies are primarily engaged in the business of leasing of aircraft and has opted for section 115 PAA. Okay, so what is the issue of gamma and fee? So as we move forward, so here the data is given. Okay, dividend of 5,41,200 is due to be received in Jan 2025 by Gamma from fee, which is also a company located in GIF IFSC. Okay, so here what is happening is that is due to be received by Gamma from fee. So fee is a company which is going to pay the dividend of 5,40,000 something to Gamma. Fee is a company which is going to pay the dividend of 5,40,000 something to Gamma, and in the MCQ, what it is saying that both the companies, means both Gamma as well as fee, are primarily engaged in the business of leasing of aircraft. Okay, it means one unit of IFSC which is primarily engaged in the business of leasing of aircraft is paying a dividend to another unit of IFSC which is also primarily engaged in the business of leasing of aircraft. Dear friends, to make India a hub of aircraft leasing business, section 1034B provides that. Okay, let me make you guys to read a bit. Section 1034B provides that. What section 1034B provides? Page number 135. It will give you more clarity, although you guys know everything already. But okay, any income of a unit of IFSC primarily engaged in the business of leasing of aircraft by the way of dividend from a company being a unit of IFSC primarily engaged in the business of leasing of aircraft shall be exempt. It means if a company which is located in IFSC and engaged in the business of leasing of aircraft has paid a dividend to another company which is also located in IFSC and engaged in the business of leasing of aircraft, that dividend income shall be exempt. Means that means no tax liability on such dividend income, so the dividend would be exempt. Okay, the last question, I think question number, okay, there are two more questions. Question number 5. Assume that for the purpose of this MCQ, alpha and beta are the banking units located in IFSC and both the companies are due to receive professional fees equivalent to 20 lakh in the previous year. What is the TDS liability by the pair? Okay, so alpha and beta have provided some professional services to some person and the payer is liable to make TDS under section 194J. Dear friends, recall, in the case of fees for professional service, the TDS liability will arise under section 194J. Are you guys getting? At the rate of 10%. But dear friends, in the case of units of IFSC, if those units are claiming deduction under section 80 LA, remember guys, if those units are claiming deduction under section 80 LA, most of their income are exempt for a very long period of time. So if the payer has to make TDS on the income of payee whose most of the income is already subject to deduction under section 80 LA, then what is the requirement of imposing TDS? So that TDS under section 194J is not liable to be deducted on the amount payable to the banking unit located in IFSC if that banking unit claims a deduction under section 80 LA. Again, on payment of fees of professional services, TDS is liable under section 194G at the rate of 10%. But if the payee is a IFSC banking unit, then no TDS liability, then no TDS has to be made by the payer if that banking unit is claiming deduction under section 80 LA. Okay. So if alpha and beta are claiming deduction under section 80 LA, then the payer is not liable to make TDS under section 194J. Okay. So here, if you see, read with me. Alpha has started availing the benefit of 80 LA from assessment year 23-24. Means Alpha has already started to avail the benefit of 80 LA. This is the assessment year 2025-26. So payer is not liable to make TDS under section 194J on the fees of professional services on the payment to Alpha Limited because it is already started to avail the benefit of 80 LA. But beta has not started to avail the benefit even though it has commenced operation. If beta has not started, then the TDS under section 194J has to be made under on the payment of fees of professional service to beta but not alpha. Okay. So for alpha it would be nil, but for beta, if the amount is rupees 20 lakh, then TDS has to be made at the rate of 10%. It means rupees 2 lakh. Then the TDS would be nil and 2 lakh. Okay. Assume that for the purpose of this MCQ, Alpha Limited is a qualifying company engaged in the shipping business. By which date can it opt for the tonnage taxation scheme? Dear friends, remember, tonnage taxation scheme provides a very favorable tax regime to the shipping companies. But since Alpha is already claiming 80 LA deduction, where most of its income are already exempt, then what is the need of opting for tonnage taxation scheme? So for the units of for the IFSC unit, if they want to opt for the tonnage taxation scheme, they have to apply for the tonnage taxation scheme within 3 months. Again, within 3 months from the end, within 3 months on which their deduction under section 80 LA ends. Okay, let me to make you guys read to read a bit. Okay. Okay, for the units of IFSC, a unit of IFSC which has availed a deduction under section 80 LA may make an application within 3 months from the date on which such deduction ceases. Means when the deduction under section 80 LA ceases, within 3 months from that date, if the entity wants to claim the tonnage taxation scheme, wants to be in the tonnage taxation scheme, then it has to opt for the scheme. Okay, so dear friends, you know that the section 80 LA deduction is for 10 years. When Alpha has opted for 80 LA, sir, with effect from assessment year 22-23, no, with effect from assessment year 23-24. From when Alpha has opted for 80 LA 23-24, it means previous year 22-23. It means started from 1/4/2022. From when the 80 LA deduction is effective for Alpha 1/4/2022, when the 10 years will end, sir, 31st/3/2032. Alpha is getting the deduction under section 80 LA with effect from 1/4/2022, and this deduction will continue for 10 years. It means this deduction will continue up to 31st/3/2032. It will cease with effect from 1st April 2032. It means that the deduction will cease from 1st April 2032. And if Alpha wants to opt for the tonnage taxation scheme, then it has to make an application within 3 months from the date on which the deduction under section 80 LA ceases. It means that the application should have to be made at least by 30th June 2032. I hope you guys are getting. Okay. So this should be the right answer. Moving on the case scenario 2, on 1/5/2024, ABC Limited, a listed company, offered right shares in the ratio of 1:10 at a value of rupees 50 per share. Okay, one of the shareholder, Mr. Sahil, had 50,000 shares. Okay, so it means that Mr. Sahil already has 50,000 shares of ABC, and the right is offered in the ratio of 1:10. Then how many right shares the company has been offered to Mr. Sahil, sir? 50,000 at the ratio 1:10 means 5,000 shares. Okay, so Mr. Sahil has been offered 5,000 right shares by ABC. Okay, on the date. Okay, Mr. Sahil retains 30% of the right. Means out of the 5,000 rights offered by the company, Mr. Sahil has himself opted for 1,500 shares and renounced the balance right in the favor of his friend Mr. Jay, and renounced 3,500 right shares in the favor of Mr. J. And for each right, Mr. Sahil has charged rupees 15 per share. Dear friends, remember, as per section 55, if you have renounced the right shares, then any amount that you are earning from such renouncement, as the cost of acquisition is nil, that amount is your capital gain, and the period is short term, so that is the short term capital gain. So on 3,500 shares, Mr. Sahil has earned rupees 15 each share by renouncing the rights in the favor of Mr. Jay. So how much short-term cap gain Mr. Sahil must have earned from this transaction? 3,500 shares into 15, it comes 52,500. This is the amount of short-term cap gain which Mr. Sahil has earned. Are you guys getting? By right renouncement. So as Mr. Jai has purchased the shares and Mr. Jai has paid rupees 15 to Mr. Sahil and rupees 50 to the company. Please, dear, please. As Mr. Jai has purchased the shares and for these shares he has paid rupees 15 per share to Mr. Sahil and 50 per share to the company. So for Mr. Jai, the cost of acquisition of each share would be rupees 65 because 50 he has paid to the company to get the shares and 15 he has paid to Mr. Sahil to get the rights. Okay. So the cost of acquisition of shares for Mr. Jai would be rupees 65 per share. Moving ahead, Mr. Sahil has transferred 10,000 shares out of his original share. Dear friends, remember, Mr. Sahil has a total 50,000 original shares, and he has get I think 1,500 more shares as a in the right issue process. Okay, but he has sold 10,000 shares out of his original shares. How much original shares Mr. Sahil had? 50,000 shares. Okay, on 15/7/2024. Okay, 15/7/2024 for 65 per share. Okay, he had acquired these 10,000 shares at a cost of rupees 2,38,000 on 21/6/2021. And here it is mentioned that STT has been paid in the shares of ABC. It means that Mr. Sahil has sold 10,000 shares which he has purchased for rupees 80 per share, for rupees 238 for rupees 2,38,000 on 21/6/2021. As these shares are listed in the stock exchange and the transaction is subject to securities transaction tax and the period of holding is more than 12 months, hence this transaction will be subject to section 112A. Are you guys getting? And as the period of transfer is 15/7/2024, means not 23, means not 23rd July 2024 onwards, the rate of tax would be 10% after providing 1,25,000 exemption. I hope you guys are remembering. Okay, so what would be the cap gain of Mr. Sahil from the sale of 10,000 shares? Sir, 10,000 shares Mr. Sahil has sold for 65 per share minus 238. So the cap gain should be 4,12,000. Are you guys getting? So if you are going to calculate the cap gain for Mr. Sahil, it should be 4,12,000 from the sale of the shares, the 10,000 shares, as well as he has renounced rights in the favor of Mr. Jai, from which he has earned the short-term cap gain of 52,500. Are you guys getting? Okay. Moving ahead, all these have been done. Okay. Okay. Now from here, XYZ has bought back 80,000 shares. Okay, dear. Here the company has bought back the shares. Dear, remember, if the bought back has been made up to 30th September 2024, then the company has to pay the additional income tax, the bought back price, the amount which the shareholder receives on such buyback would be exempt in the hands of shareholder under section 1034A. But if the bought back has been made with effect from 1st October 2024 onwards, the company is not liable to pay any additional income tax, but the gross amount which the shareholders receive on such buyback would be treated as a deemed dividend in the hands of shareholder under section 222F. But sir, what about the cost of acquisition of shares which has been bought back? The cost of acquisition of such a share would create a loss under the head capital gain as per section 46A, and that capital gain loss can be set off or carry forward and set off as per the provisions of the act. Okay. See with me. Okay. The XYZ has bought back 80,000 shares. Okay. Such bought back shares includes, okay, here is the main point, 6,250 shares of Mr. Sahil, which he has acquired on 28/5/2022 for 3680. Okay. How much amount Mr. Sahil is receiving on the shares which the company has bought back? Sir, company has bought back 6,250 shares of Mr. Sahil, and for each share company is paying rupees 160. So Mr. Sahil is receiving on gross basis 10 lakh rupees on the buyback. So this 10 lakh rupees would be taxed as a deemed dividend in the hands of Mr. Sahil. Are you guys getting? This 10 lakh rupees would be taxed as a deemed dividend in the hands of Mr. Sahil, and as the shares has been bought back on 1st October 2024 or onwards, no additional income tax is going to be payable by the company. Okay, but sir, as the shares has been bought back and the entire amount which Mr. Sahil has received is treated as a deemed dividend, what about the cost of shares which has been bought back by the company? Because the cost of share is, how much is the cost of share? 36 rupees 80 paisa. Then what about 6250 into 36? 6250 into 36.8 means what about 2,30,000? It would be considered as a loss, and as the period of holding is more than 12 months, that loss would be long-term capital loss. So there would be a long-term capital loss of 2,30,000 in the hands of Mr. Sahil. Sir, first let's see some MCQs. Okay, the first MCQ is, if is XYZ Private Limited required to pay additional income tax? Answer is no. As the buyback has been made on or after 1st October 2024, no additional income tax is payable by the company. Okay. No, as income tax is not payment. Additional income tax is not paid. Okay. Compute the amount of cap gain arising in the hands of Mr. Sahil. Dear friends, remember, Mr. Sahil is earning a short-term cap gain of 52,500. He is earning a long-term cap gain of 4,12,000, as well as there is a loss. There is a loss of 2,30,000 long-term capital loss of Mr. Sahil. So the net long-term cap gain would be 1,82,000 and the short-term cap gain would be 52,500. So the LTCG would be 1,82,000 and short-term cap gain would be 52,500. Okay. Calculate the amount of tax liability in the hands of Sahil. Okay, dear friends, Mr. Sahil has a long-term cap gain of 182. Mr. Sahil has a long-term cap gain of 182, as well as the short-term cap gain of 52,500. That short-term cap gain is taxable at a slab rate, as well as he has income from deemed dividend under section 222F, rupees 10 lakh. Are you guys getting? A deemed dividend rupees 10 lakh, short-term cap gain 52,500. These both income are going to be taxable at a slab rate, as well as he has LTCG of 182, and that LTCG is taxable at the rate of 10%. But sir, how much is taxable? 182 minus 125 means just 57,000 is taxable at the rate of 10%. So the tax liability would be 6,66,120, I think. Okay, so you have to calculate the tax liability, do some calculation, and under the default regime, the tax liability would be calculated and the liability would be 66. Okay, moving forward, compute the tax liability of Mr. Jay. Remember, dear, Mr. Jay has purchased 3,500 shares from the company, and for those shares he has paid rupees 50 to the company and 15 rupees per share to Mr. Sahil for the renouncement of right, and Mr. Jay has sold the shares, I think, for 80 rupees, and Mr. Jay has sold the shares for okay, Mr. Jay transferred the share for 80 rupees. So Mr. Jay has earned a short-term cap gain because the shares he has obtained on 15/7/2024 or after, and he has transferred the shares on 26/2/2025, means the period of holding is not exceeding 12 months. So the resulting cap gain would be short-term in nature. So how much cap gain Mr. Jay is earning from each share? Sir, 15 rupees. 15 rupees into 3,500 shares. So the short-term cap gain in the hands of Mr. Jay would be 52,500. As well as the salary income is 4,25,000. So short-term cap gain 52,500 and the salary is 4,25,000. He has opted out, means under the optional regime. This short-term cap gain is a taxable. As the STT has been paid, so this short-term cap gain is covered under section 111A, and as the transfer is on or after 23 July 2024, the rate of tax would be 20%, and salary income slab rate, the tax would be 8,750. So the total tax would be 19,250, as Mr. Jay is a resident and his total income is not exceeding rupees 5 lakh. Hence, he is eligible for rebate under section 87A. Maximum amount of rebate is 12,500. But sir, rebate is not allowed from cap gain. Dear friends, rebate under section 87A is not allowed from LTCG, subject to section 112A. On that LTCG, that rebate is not available, but in this short-term cap gain, that rebate is available. So Mr. Sahil can claim the rebate on this particular income also. Okay, so the tax liability would be, I think, 7,020. Moving ahead, question further says what would be whether the income arising on buyback of share taxable in the hands of Rahul. How Rahul came in the picture? Who is Rahul? Let's find. Okay. Uh, Dear friends, such bought back shares includes the shares which has been bought back by the company, includes 6,250 shares of Mr. Sahil and 250 shares of Mr. Rahul, which he has which was inherited from his father. It means that Mr. Rahul has inherited these shares from his father. So the cost of acquisition in the hands of Mr. Rahul would be the cost of acquisition in the hands of his father, and 250 shares. So what is the gross amount Mr. Rahul has received in this buyback? So 250 shares, 160. The gross amount would be 40,000 rupees. This would be taxable as income from other sources in the hands of Rahul. But sir, what about the cost of these shares? 10 rupees the cost. So that cost would create a loss of rupees 10 per share. The total share is 250. So as per section 46A, a longer term capital loss in the hands of Mr. Rahul would be 2,500. Sir, how long term? Because the shares has been acquired by the father of Rahul on 24th May 2020, and the shares has been bought back by the company on 14/12/2024. Means the period of holding is more than 1 year, means more than 12 months. Hence, the resulting loss would be long term in nature. So, what about Rahul? 40,000 IFOS as a deemed dividend and 2,500 as long term capital loss. Okay. 40,000 is a redeemed dividend and long-term capital loss. So the correct option should be B. Moving ahead, to calculate the total income and tax payable by Rahul. Dear friends, Rahul has a total income, long-term capital loss of 2,500. Okay, salary has Rahul has salary of 1242. So 12,42,000 salary, which is already computed, plus IFOS 40,000, means the total income of Mr. Rahul is 12,82,000. Sir, what about the loss? Dear friends, you cannot set off the long-term capital loss from any income other than long-term capital gain. Since Mr. Rahul do not have any income taxable as long-term capital gain in the previous year 24-25, hence this long-term capital loss has to be carried forward as per section 74 for 8 years. Okay. Means you can carry it maximum for 8 years. Okay, so the taxable income would be 1282 and the tax payable would be as per the default regime. Calculate the tax payable. Moving ahead to question number 13. Global Tech Inc., a company incorporated in USA, has a global assets worth 50 crore and Indian assets worth 25 crore. Dear friends, okay, its business turnover is the 90 crore out of the 10 board meetings held. It is important. Only 4 are held in India. Dear friends, if majority of the board meetings of a foreign company are held outside India, if majority of the board meetings of the foreign company are held outside India, then in the normal circumstances, the POEM, the place of effective management of that company, would also be considered to be situated outside India if the company satisfies the active business outside India test. Are you guys getting? One of the conditions of active business outside India is that Indian assets should be less than 50% of the total assets. Indian assets is 25 crore, global assets is 50 crore. Means the total asset is 75 crore, so the Indian asset is less. It means that AOB, active business outside India test, gets satisfied because we don't have more data. So we cannot say that ABOI test is not satisfied. And ABOI test is satisfied and majority of the board meeting are held outside India. So it is indicating that the POEM of the company should be outside India. Okay, but as you read further, however, key management and commercial decisions of the for the conduct of the business as a whole were made in India at these meetings. Dear friends, even if the majority of the board meeting of the company are held outside India, we are only concerned with those decisions which are necessary for the conduct of the business of the company as a whole, which is called key management and commercial decisions, and the place where those decisions has been taken. As the question clearly mentions that the key management and commercial decisions of the company are being held in India, hence the POEM of the company should be in India. Even though the majority board meetings are held outside India and the company satisfies ABOI test, it does not matter, as company takes the key management and commercial decisions in India, the poem of the company should be in India. And as the poem of the company is in India, it should be a resident in India for the previous year 24-25. Okay. So it means that Global Tech is a resident in India. Okay. Issue is what, moving further, Innovate Limited, in Indian company, intends to remit FTS to Global Tech for providing services. Okay, there is a company named as Innovate, and it has to pay to Global Tech fees for technical services. Dear friends, fees for technical services, if you consider fees for technical services, okay, Innovate is a payer and Global Tech is a pay. The payer has to make TDS, but issue is that FTS is subject to TDS under section 194J as well as 195. If the payee is a resident, TDS has to be made under section 194G at the rate of 10%. If the payee is a non-resident, TDS has to be made. If the payee is a non-resident, TDS has to be made under section 195 at the rates in force. Sir, what would be the rate at which the FTS income will be taxed in the hands of the non-resident? It depends upon whether the non-resident has a PE in India or not. If the non-resident has PE in India and the services are effectively connected with such PE, then the tax liability would be under 44 DA. Then the tax liability would be under 44 DA, and the rate of tax of the foreign entity will apply. And here, as it is a company, the rate of tax would be 35%. But if PE is not in India or the services are not connected with the PE, then the taxability would be as per section 155A at the rate of 20% on gross basis. But this 20% rate would apply only if the agreement has been approved by the central government. But here the question says that the agreement is not approved by the central government. So as the agreement is not approved, the rate of tax would be 30%, means the higher rate will apply. But the issue is whether Innovate has to make TDS under section 194J considering Global Tech as resident because the poem of the company is in India, or treating it as a non-resident. Dear friends, CBDT has clarified that in case the poem of the foreign company is considered to be in India, and because of the poem, more than one rate of TDS becomes applicable on that foreign company. In this case, TDS is attracted under section 194J as well as 195. Then only the TDS under that section has to be made, which will apply to the payee considering it as a non-resident. Okay, it means that even though the Global Tech has become a resident, considering the poem of the companies in India, but the payer has to make TDS considering Global Tech as a non-resident. Then, sir, what is the use of making Global Tech a resident of India? Okay, then Innovate has to make TDS under section 195, and the rate of TDS would be rates in force, means 35%, because the agreement is not. So the question is, what is the residential status of Global Tech? Global Tech is resident because the poem of Global Tech for the previous year 24-25 is in India. And what is the rate of TDS? So the Global Tech is resident, but the TDS would be 35% under section 195. Okay. Moving ahead, this is a good question. Question number 14, a comprehensive PGBP and a total income question. The statement of P&L of Tirupati Private Limited, a domestic company engaged in manufacturing, shows a profit of, okay, for the financial year after debit credit, whether the company is under any alternate regime. Question says the company has opted for, okay, the company has opted for 115BAA, means company is under section 115BAA. So what are the adjustment that you have to make? Okay, its a statement of P&L has the following credits: rent received from vacant land. Dear friends, any rent that you receive from a vacant land is taxable under the head income from other source. This rental income of 255 has to be taxed under IFOS. Okay. A rent received from a commercial property owned by the company, 5,30,000. TDS has been made by the tenant at the rate of 10%. So the TDS must have been made under section 194I. Okay. Dear friends, issues that under which head this rental income is going to be taxed. Dear friends, remember very clearly, if property is residential in nature, then the rental income will always be taxable under the head house property. Okay, as clarified by Finance Act 2024. But if the property is commercial in nature, if the property is commercial in nature, then the rental income can be considered. Then the rental income can be considered as PGBP income. If renting of the property or if leasing of the property is the main or substantial business of the assessee. Case law is Chennai Chennai Properties Investment something, there is a case which says that if leasing of the property or if renting of the property is the main or substantial business of the assessee, then the rental income from the commercial property shall be taxed as a business income. But here, as the main business of the assessee is manufacturing, this judgment would not apply, and because of this, rental income from commercial property has to be taxed under the head house property. Okay. Interest on income tax refund, it is taxable, although the amount of income tax refund is not taxable, but the interest on such refund is taxable. Okay. Profit on sale of plot, as the trade as sale and purchase of plot is not main business of the company, hence it is cap gain, so it has to be taxed under the head cap gain. Dividend from ABC, dear, any dividend which the company receives is the taxable under the head income from other sources, and as the company is resident, company can claim up to 20% of the interest cost as a deduction under section 57 from that dividend income. Okay. Debit is in P&L account includes depreciation. This depreciation must have been as per Companies Act, so add back this depreciation. Donation to Swachh Bharat Kosh. Dear friends, this donation is eligible for a deduction under section 80G, but as company is in under alternate regime under section 115 BAA, 80G is not available, so this donation is not allowed. Actual contribution to the pension fund of the employees. Dear friends, if the employees are subject to new pension scheme, then the employer can contribute up to 14% of the salary plus DA as contribution to the employees. If employer contributes more than 14%, then the amount contributed in excess of 14% is not eligible as a deduction, is not available as a deduction to the employer. Here we have to see how much is the salary amount of the employee. So if you move in forward in the question, in point number 7, it says that the eligible salary and DA for the pension scheme is rupees 10 lakh. So how much is the maximum amount the employer can contribute? 1,40,000. Okay, 1,40,000 being 14%. 1,40,000 is the maximum amount if that will be available to you as a deduction. But here the contribution is 1,90,000, so 50,000 is the excess contribution which has to be added back to calculate the taxable income. Okay. Payment made to a transporter rupees 68,000. Dear friends, if you are making payment to a transporter, then the TDS implications will arise under section 194C. But dear, TDS under section 194C is not required to be made on goods carriage if the goods carriage do not own more than 10 goods carriage vehicle and he gives a declaration and his PAN, then you are not required to make TDS under section 194C. Okay. Payment made to transporter of rupees 68,000 by account paycheck, but no TDS has been made. Transporter is having PAN. Transporter has given PAN, has furnished you the declaration that he is covered under section 44A and not having more than 10 goods carriage. So in this case, 194C TDS is not attracted, and if you have not made the TDS, there is no issue. Okay. Bonus to employees 4,48,000. Dear friends, as per section 43D, bonus to employees is allowed on actual payment basis. 43B basically, not 43D. 43B, payment of bonus to employees is allowed on actual payment basis. So if the payment is made on 18th December 2025, then it would be allowed as a deduction in the previous year 25-26, not in the previous year 24-25. So in the previous year 24-25 working, we have to add back 4,48,000. I hope you guys are getting. Okay. Provision made for income tax including interest, this is the personal liability of associate, it is not allowed, hence has to be added back. Contribution to university, if you are making any scientific contribution, the deduction is not eligible if you are in the alternate taxation regime in section 115 BAA. So this contribution is not allowed as a deduction, so add back. Okay. interest of 1,50,000 on loan borrowed for acquiring shares. Okay, so you have obtained a loan of 1,50,000 to acquire shares, and from those shares you have earned a dividend of rupees 6 lakh, and you have paid interest of 1,50,000. How much deduction for the interest expense would be allowed? Up to 20%, means 1 lakh 6 lakh into 20% means 1,20,000. Although the interest in the actual interest payable is 1,50,000, but only up to 1,20,000 of interest income of the interest payment would be allowed as deduction. So the dividend taxable would be 480. Okay. Moving ahead. Okay. Depreciation as per Income Tax Act is 18 lakh. However, while calculating such a depreciation rate applicable to computer, such a depreciation, okay, rate applicable to computer has been adopted for accessories. Dear friends, what is the depreciation rate for computer? 40%. What is the depreciation rate on computer software? 40%. What is the depreciation rate on computer accessories like scanners, printers? Sir, 40%. Okay. So if company has used 40% rate for printer and scanner, there is no issue. But what is the depreciation rate on EPABX? Sir, 15%, because it is considered as a plant and machinery, not as a computer. But you have a charged depreciation at the rate 40% on EPABX, but only 15% is allowed. So 25% of depreciation has to be added back. Okay. The WDV of EPBAX as on 1st April 2024 was 5 lakh. So 5 lakh into 25%, it means 1,25,000 has to be added back. So the allowed depreciation would be 1 lakh 16 lakh 75,000. Right. Okay. Additional depreciation. Okay, dear, additional depreciation is not eligible on 15 BWRA. Okay, provision for audit fees of 1 lakh was made in the books in the year ended 31st March 2024 without TDS, without deducting TDS. Dear, audit fees is an allowed expenses. You can claim its deduction under section 37, but you have not made TDS in the previous year 23-24. Hence, as per section 40A1A, 30% of it would have been disallowed in the previous year 23-24. Such fees was paid to the auditor after TDS. So that 30% means 1 lakh into 30% means 30,000 would have been allowed in the previous year 24-25. So 30,000 would be allowed to you as a deduction. Okay. Okay. During the financial year 23-24, company has made a provision for outstanding bill of 90,000. As the company is following mercantile system of accounting, this 90,000 can be claimed as deduction in the previous year 23-24. Okay. Out of such outstanding amount, company paid 45,000 in cash. Dear friends, if you have claimed any deduction on accrual basis, and if that amount you pays by exceeding rupees 10,000 by a mode other than specified mode, then that payment would be considered as your income in the previous year in which such payment is made. So here company pays 45,000 rupees in cash, which is not a specified mode. Hence, as per section 40A3A, that 45,000 would be treated as the income of assessee in the previous year 24-25. Okay. As the company is a private company, company has issued 1 lakh equity shares for a price which is more than face value. Dear friends, it used to be taxed under section 56(2)(7)(b), but now it is omitted, so there would be no tax treatment. Plot sold, so that would be cap gain, that we have already seen. And okay, so moving ahead, question number 15. Vatsal, Vihan and Vayu are equal partners of VSK and Company, which was formed with effect from 1/4/2024. Means it is a partnership firm. Okay. The firm is an authorized dealer of shoes. Okay. It reported net profit of rupees 4,50,000 as per P&L after debit credit of the following items: depreciation on generators and computers. This should be as per Income Tax Act. So we first add 1,10,000 and the depreciation as per Income Tax Act we will allow to you. Okay. Working partner salary 82,000 per month. Dear friends, for the partnership firm, the salary is allowed as per the provisions of section 40B, limits and limitations. So if you have already paid any salary and claimed it as a deduction, to compute the taxable income, we will add it back. So 82,000 into 3 into 9, because the company is 1st June, okay, April, May, so 10 basically. 82,000 into 3 into 10. So the amount that we have to add back as remuneration is 24,60,000. I think. Okay, 24,60,000 and 1,10,000 as depreciation. Okay. Interest on capital to partner is allowed, but maximum 12% per annum. The total interest debited is 3,60,000. So the 3,60,000 is calculated considering 18% divided by 18%. So the capital or loan which is eligible for interest must have been rupees 20 lakh. Only 12% is allowed. So maximum interest allowed is 2,40,000. So 1,20,000 should be added back. Okay. Moving ahead, donation to registered political party by cash. Any donation exceeding 2,000 by cash is not allowed. 70,000 by electronic transfer, it is allowed, but it is not allowed as PGBP deduction. It is allowed under section 80 GGC from gross total income. So we have to add back 1,50,000. Okay, donation. Monthly rent paid to partner. Dear friends, if a partnership firm pays any rental to its partner, it is allowed as a deduction in the hands of partnership firm, subject to the subject to the provisions of section 48(2), because for a partnership firm, its partner is a specified person, and if the rental amount is not as per the market rate, then the disallowance may attract or the disallowance may occur as per section 48(2). Okay. So the rent that you are paying is rupees 36,000 per month, and it is occupied from 1st October 2024, means for 6 months. The market rent of the premises is 15,000 and no TDS has been made. Dear friends, on rent, TDS has to be made under section 194I if the aggregate rent exceeds rupees 2,40,000. Here, the aggregate rent for the entire year is for 6 months only. 36,000 into 6 equals to 2,16,000. Hence, in this case, no tax is deductible under section 194I. So, there would be no consequence in case the tax has not been deducted by the partnership firm under section 194I. But yes, as the market rent is just 15,000, the excess payment is rupees 21,000 per month for 6 months. So this amount would be disallowed under section 48(2). So 1,26,000 has to be added back. Okay. Moving ahead, the firm incurred rupees 5 lakh by the way of expenditure towards the cost of gold coins awarded to customers on the first day of the showroom inauguration. The cost of gold coin is 10,000, less than 10,000, and lucky draw. Dear friends, if you are giving any benefit or perquisite to your customers, then the TDS obligation may arise under section 194R, and if you do not make such a TDS, then 30% disallowance may attract under section 140A1A. Here 194R is not attracting because the perquisite value is not exceeding rupees 20,000. Hence there is no TDS obligation under section 194R. Hence no disallowance because of the non TDS will occur. Okay. Depreciation allowable as per section 32, 2,43,000. We will less 2,43,000. And one registered trademark was acquired on 10/7/2024, but it has been put to use with effect from 1/12/2024 because of some dispute. So the amount is 3 lakh into 12.5%. So the trademark depreciation would be 13,7,500. Okay, so we have considered everything, I think. Okay, all the partners are working partners and salary and interest is allowed. But dear friends, we have done all the working. Only thing that remains is to calculate the book profit of the firm and calculate the maximum amount of remuneration payable. Book profit as per section 40B means the profit calculated under the head PGBP after allowing all the expenses allowed as per the provisions of the act, but before considering the remuneration, means remuneration deduction will not be allowed. So the book profit of the firm will be I have already calculated 31,35,500, I think. So the maximum remuneration is as per book profit. Remember what would be the maximum remuneration? First 6,90,000, then the balance 60%. 31,35,500. Okay. It would be 20,61,300. And what is the amount of remuneration company has paid 24 company has paid 24,60,000. So the maximum remuneration that would be allowed in the hands of the partnership firm would be 20,61,003. And after gross total income deduction under section 80 GGC rupees 70,000. Okay, I hope you guys are getting. Moving ahead very quickly, dear friends, this is a question of charitable trust, and this question covers the concept where a charitable trust makes donation to another charitable trust. Then what would be the situation? Okay, here, if a charitable trust makes a donation to another charitable trust, the donation which is made by the donor trust can be out of the current income of the donor trust. So if the donation has been made out of the current income of the donor trust, if the donation is for the corpus purpose of the recipient trust, the corpus purpose means this amount of donation would be kept as a FD or something by the recipient trust. The money will not actually circulate in the economy. So what is the use of the donation? So if the donation is out of the current income, but the donation is for corpus purpose, then then such donation would not be considered as an application for charitable or religious purpose by the donor trust. Okay, not treated as an application in the hands of the donor trust. Means the donor trust will not get any tax benefit. But what about the recipient trust? The recipient trust has received the corpus donation. The recipient trust shall keep the money in section 11.5 mode, and that income will be exempt. The recipient trust is not liable to pay any tax and even not liable to apply 85% of the corpus amount. Just keep it in section 11.5 mode. Okay. If the donor trust is making donation out of the current income for the purpose other than corpus, then the other purpose means the money will be utilized for some actual things. So for the donor trust, the application will be allowed, but maximum 85% of the donation. Say the donor trust has made a donation of 2 lakh. Then for the donor trust, the application will be just 1,70,000. For the recipient trust shall apply 85% of it for the charitable or religious purpose in India. Then the no tax liability on such income means it will exempt under section 11. Okay. What about if what if the donor trust makes the donation to the recipient trust out of its accumulated income? Dear friends, if the donor trust is making donation out of the accumulated income for any purpose of the recipient trust, whether for corpus or otherwise, it is not treated as an application for the donor trust. Yes, for the recipient recipient trust can apply 85% of it for charitable or religious purpose to get exemption. And if the donation is for corpus purpose in the hands of recipient trust shall simply keep it in 11.5 mode and the exemption will apply. Okay. So what is the question? How much amount paid by XYZ charitable trust will be considered as an application if it is for general purpose and not for corpus? It has paid 200 lakhs, so 85% will be allowed as an application, means 170 lakh. If it is for corpus, then no application. Okay. What would be your answer if such amount is paid out of the accumulated income? If the trust has paid anything out of the accumulated income, then no application will be allowed to the donor trust. Okay. Also examine the conditions with the ABC educational trust, means the recipient trust. If the recipient trust receives any money as a corpus donation, simply keep it in section 11.5 mode and it will be exempt even without applying. If the recipient trust receives any income other than for corpus, then apply its 85% at least for charitable or religious purpose in India, then it will be exempt under section 11. Okay. Moving ahead, Mr. Amit, an Indian resident, invested in BDA such as cryptocurrency and NFT. On 15 April 2024, he purchased one Bitcoin for 60 lakh. Okay, his friend Sushil gifted him NFT. Dear friends, if NFT are being gifted, section 56 to 10 will be attracted because virtual digital asset is considered as a property for 56 to 10. Okay. The NFT which has been gifted has FMV of 5 lakh. As the FMV is exceeding rupees 50,000, entire 5 lakh would be taxed as the income from other sources in the hands of Mr. Amit being the recipient of the gift. Okay. Sushil has bought anyhow. Mr. Amit buys NFT worth 10 lakh on 16/11/2024. He has also purchased NFT for rupees 10 lakh. Okay. It means that Amit has purchased NFT. Okay. Due to some financial needs, he sold 0.5 Bitcoin for 28 lakh. It means Mr. Amit has sold Bitcoin for 28 lakhs. The buyer must have made TDS under section 194S of 1% of the consideration. Okay. And NFT he has sold for 6,50,000. Then again 194 STDS. He incurred expenses. Dear friends, in computing the income from virtual digital asset, only cost of acquisition is allowed. Any expense other than cost of acquisition is not allowed as per section 115 BBH. Okay. He has other income of 6,50,000. Compute the tax liability. So what would be the taxable income of Mr. Amit? First, Bitcoin. Okay, Bitcoin that he has purchased for 30 lakh, he has sold it for 28 lakh. Although there is a loss of 2 lakh, but loss from the sale of VDA is a dead loss. So nil. He has received NFT. No. He has sold NFT basically. He has purchased NFT. Okay. What about NFT? Okay, yes, he has received NFT from his friend, the value of which is 5 lakh, and he has sold it for 6,50,000. Dear friends, 6,50,000 is the sale price, and the gift NFT that you have received from your friend, although it was free of cost, but as 56.210 has been attracted as per section 49.4, the cost of such NFT in the hands of Mr. Amit would be 5 lakh. So the profit would be 1,50,000. Gift, you have received NFT from your friend which is exceeding the FMV and the limit of 50,000. So the entire FMV of 5 lakh is taxable. Other income is given 6,50,000. Total income is 13 lakh, out of which this 1,50,000 is going to be taxed at the rate of 30%, and remaining income is going to be taxed at slab rate and TDS. And when you have sold the Bitcoin for 28 lakh and NFT for 6,50,000, 1% TDS has been made by the seller. So the TDS already made is 34,500. Tax liability is this much. Okay. Moving ahead, won't take much of your time now. Okay, question number 18, I think. Question number 18. During the previous year, Mr. Vikas, a non-resident, became a partner in a partnership firm Palan Company and contributed 50 lakh towards capital. He has paid interest. He was paid interest of 10% on the interest of on capital and his profit share. Okay, the profit share was 4 lakh rupee. The firm paid 5 lakh to Mr. Vikas. Actually, this is Vivek. Mr. Vikas, a non-resident friend of Vivek, towards fees for technical services. Okay, what is the issue? As the tax consultant of Palan Company, you need to advise the firm regarding the TDS on the payment made to Vivek and FTS to and FTS payment to Vivek, considering India has no DTAA. In case tax is not deductible at source, is there any other related requirement to be complied with? Dear friends, company partnership firm is making payment to Mr. Vivek. His partnership firm is making the payment of profit share. Profit share is exempt in the hands of Vivek under section 10(2)(a). And partnership firm is paying interest to Vivek. Although interest other than interest on security, TDS has to be made under section 194A. But as Vivek is non-resident, TDS will have to be made as per section 195. So the TDS will be made under section 195. Okay. And on the FTS payment to Vikas, the TDS will be made under section 195 at the rates in force, because the FTS is taxable at the rate of 20% under section 115A. Dear friends, as per section 195(6), if you are making any payment to a non-resident or a foreign company, whether or not such payment is subject to tax, you have to furnish the details of such payment to the authorities. So the partnership firm has to furnish information of all payment to NR foreign company, whether such income is chargeable to tax in India or not, as per section 155(6). Okay. Moving ahead, if India has a DTAA with country X providing for TDS at the rate of 10% on FTS, what is the remedy available? Dear friends, as per DTAA, the TDS rate is 10%, but the TDS has been made at the rates in force, means 20%. As higher TDS has been made, you can apply for a refund. Okay. Moving ahead, question number 19. Mr. Bhuvan proposes to purchase for his business certain raw material from Mr. Srinivas. In view of the scarcity, Srinivas insists on cash payment. Dear friends, in this case, Bhuvan is a buyer and he is purchasing something for his business that he wants to claim as an expenditure, because the raw material that you are buying is you can claim as an expenditure. Okay. Srinivas is a seller and Srinivas wants cash payment, to which Bhuvan agrees. Dear friends, as per section 40A3, payment exceeding 10,000 to a person in a day, that deduction will not be allowed for tax purposes. So if one makes payment of 3,20,000 in cash, he cannot claim it's a business expenditure as per section 40A3. What about Srinivas? As per section 269 SS, as per section 269 SS, I think, yeah, 269 SS, sorry, 269 ST. No person should receive, from a person in a day exceeding rupees 2 lakh, of 2 lakh or more from a person in a day. So if Srinivas is receiving from Mr. Bhuvan rupees 2 lakh or more in a day or in respect of one transaction, then section 269 ST violation will occur and penalty of rupees 3,20,000 will be imposed in the hands of Srinivas. Okay. In respect of the above transaction, okay, what would be your answer if the cash purchases are effected by Bhuvan on two different dates for two different raw material, 180 and 140? Here, dear, Bhuvan is paying 180 in cash, 180,000 in cash, exceeding 10,000 in a day. So again, 40A3 will attracted and 180 will be disallowed. Again, 40A3 will be attracted and 140 will be disallowed. What about Srinivas? Srinivas is not receiving rupees 2 lakh or more from a person in a day or in respect of a single transaction, because here there are two different dates for different raw material. Hence, in this case, 269 ST violation is not occurred or not made by Srinivas, so no penalty. Okay. Moving ahead, question number 20. Mrs. Sudha Sharma, aged 61 years, is married and settled in Calcutta. She is a Hindustani classic singer and composer who performs concerts. Okay. She visits country M every year during the music season and participates in the music concerts there. Okay. It means that you are earning money from country M by participating in concerts there. Means your profession means PGBP income. Okay. Income from concerts, India PGBP 10 lakh, country M CMD 12 to 25. Dear friends, here the foreign currency income is mentioned in foreign currency. So foreign currency income, foreign country income is mentioned in foreign currency. Dear friends, if foreign country income is given in foreign currency, you have to convert it into INR and you have to use the rates given as per rule 115. As per rule 115, if you are converting the PGBP income which is given in foreign currency into INR, then you have to use the TTBR of the last day of the previous year. So what rate you have to use? Last date of the previous year of the C, TTBR of the last date of the previous year. So if you want to convert this 12 to 45 into INR of the previous year 24-25, then you have to use the TTBR of 31st March 2025. And what is the TTBR? TTBR 31st March 2025, 80 rupees. So in Indian currency, this PGBP income would be 979,600. So PGBP income of Ms. Sudha from India is 10 lakh, from country M is 979,600. Okay. TDS made in country M in October 2024 in respect of such income is 2,500 CMT. Dear friends, here the tax which has been deducted in country M is also given in foreign currency. Dear friends, if the tax details are given in foreign currency, then as per rule 128, to convert that foreign currency into Indian currency, we have to use the TTBR of the currency of the last date of the month preceding the month in which the tax is deducted or paid. So the tax is deducted on October 24. We have to use the TTBR of 30th September 2024. So what is the TTBR? Okay, 80 rupees. So how much tax has been deducted in the foreign country M? 2 lakh rupees. Okay. She earns income of CND 10,000 by way of royalty. Royalty is again PGBP. You are earning $10,000. So again we have to use the TTBR of 31st March 2025 of country N, which is 79. So 7,90,000 is again your PGBP income, but this is from country N. Okay. So you have any other income? Okay, this is done. And the royalty at the rate of 10% means 1,000 C and D, and 25th March means 28th Feb 78 rupees. So the royalty, the tax on royalty is 78,000 rupees. Okay, in India, she has interest income of 4 lakh from bank FD in her name and 25,000 from savings bank account. So 4 lakh 25,000 is other source income. She pays medical insurance of 27,000 to ensure her health and 30,000 to ensure the health of her husband. Both of which combined would be 50,000 deduction under section 80D. She deposited 1,50,000 PPF. Okay, so ATC would be 1,50,000, but all these are available in the optional regime only. In the optional regime, so ATC will be 1,50,000, ATD will be 50,000, and as you are earning interest from deposit, TTB will be for 50,000. So 50,000. Then the total income of Ms. Sudha will be 29,44,600, and the tax as per slab rate will be 7,21,115. Here the rebate under section 91 as well as the relief under section 90 is available. So the relief and rebate will be the lower of Indian tax as well as the tax of the foreign country. So the Indian rate is 24.489%. So first let's talk about the rebate or relief under section 91. 91 means country M, because India don't have a DTAA with country M. Okay, so here the rebate will be given under section 91, which will be lower of Indian tax as well as the foreign tax. How much is the Indian tax on the income from country M? So 24.489% of rupees 9,79,600. And what is the foreign tax? We have just calculated 2 lakh rupees. So it is how much? Country M, 2,500 divided by 12245. It is 20.416%. So it is lower. So this would be the amount of rebate. So Indian tax would be at the rate of 24.489%, 2,39,894, as well as the foreign tax would be 2 lakh, whichever is lower means 2 lakh. So you will get a rebate under section 91, which is rupees 2 lakh. As India has DTAA with country and we have to read the DTAA a bit. Here is the extract of DTAA. Here it says the amount of tax paid under the law of country N. Okay. In accordance with the provisions of DTAA, whether directly or by deduction by a resident of India in respect of income from sources within country N, which is subject to tax in India, and country N shall be allowed a credit against the Indian tax payable in respect of such income, but in means again the tax rebate under section 90 will again the lower of Indian tax as well as the foreign tax. So the Indian tax is 193,463, foreign tax is 78,000, the rebate would be 78,000. So the final tax liability will be 44,312. Okay. I don't want to take much of your time. Moving to question number 21 very quickly. Manan, who remained in country X, returned to India permanently on 1st Feb 2024. So for the previous year 24-25 means 1st April 2024 onwards, you are completely in India. So 182 day condition is fulfilled, but you have not visited India before. So you are NOR basically. Okay, for NOR, which of the income are taxable in India? Income received in India, deemed to received in India, occur arises in India, deemed to occur arise in India, occur arise outside India from a business control or profession set up in India as per section 5. Okay. He has a house property in country X. So this house is in country X, means source of income or asset is outside India, from which he earned and received rental of 30,000 and 34,000. Okay. respectively in the bank account maintained in country X. Dear friends, this rental income has already been received in country X. So this rental income is not going to be taxed in India as Mr. Manan is a NOR. If Mr. Manan would have been ROR, then such rental income would have been taxed in India. And if that rental income has been received in the Indian bank account, then again such rental income would have been taxed in India, whether Mr. Manan was NOR or NR. But as he is NOR and the rental income has not directly been received in India, because of this, these rental income are not taxable in India. I hope you guys are getting. Okay. Okay, so these data are irrelevant for us basically. From here the data is relevant. His income from business is PGBP 12,50,000 means PGBP income 12,50,000. Okay. He transferred land situated in Indore on 31st 12 2024 means you will not get indexation to calculate LTCG to Mr. Sarthak for 80 lakh. Cost is 30 lakh, so LTCG would be 50 lakh. So PGBP income of Mr. Manan 1250 and LTCG would be 50 lakh. So the gross total income is 62 lakh 50,000. Now the issue is to calculate the tax payable PGBP income slab rate, and as far as the LTCG is concerned, the tax would be 12.5% without indexation. But as Manan is a resident, but sir, he is NOR, although he is a resident, and the property which has been transferred is land or building or both, which has been acquired prior to 23/7/2024, then the tax would be 12.5% without indexation or 20% with indexation, whichever is lower. So the tax as per 12.5% without indexation will be 6,25,000, and the tax with 20% indexation will be how much? 7,15,000. So it is better to claim 6,25,000. So here the tax liability will be calculated. Okay, moving ahead quickly. Question number 22, I think, is the last question. Okay. Triveni Cement Limited is an Indian company having its head office at Chennai. For the previous year 24-25, it furnishes the following information of certain entities and the transactions undertaken. Okay, Drift is a wholly owned foreign subsidiary in Japan of TCL. So the TCL and Drift are associate enterprise. It is currently paying royalty of 3 million to TCL for the supply of know-how, where the market rate of royalty is 4 million. Dear friends, a royalty that you are receiving from your subsidiary is 3 million, but ALP of the royalty is 4 million. So we will calculate the income by increasing 1 million. 1 million means 10 lakh, and 10 lakh USD. Each USD 82 means 820 lakh rupees income will be increased in the hands of Triveni as per CUP method. Okay. TCL has borrowed a sum equivalent to 220 crores from Swift Dubai on the state the assets position. Dear friends, if the borrowing constitutes not less than 51% of the book value of the total assets, you two are associated. So the book value of the total assets of Triveni is 330 and the borrowing is 220. So the ratio is 66.67%. You both are relative, and this loan transaction would be international transaction. TP will apply. Okay. How much interest you are paying? 17 crore 6 lakh at the rate of 8%, but the market rate is 7%. So 1% interest will be disallowed. So 17.6 crore divided by 8% into 7%. So the arm's length interest is just 15.40 crore. You are paying 17.6 crore. So the total income will be increased by 220 lakhs. Okay. I think last point, TCS supplied goods to Truewood in Singapore. The paid up capital of Truewood Limited in foreign currency 92 crore means the total paid up capital of Truewood is 92 crore, out of which TCL holds just 22% of just 22 crore. So how much equity or how much voting right TCL owns in TWL is 22 divided by 92, which is 23.91%, which is less than 26%. Hence these two are not associated, hence no TP adjustment will be there. Okay, so I hope, dear, this very quick analysis of RTP will prove beneficial for you guys. So it is all for today. So do share with your friends, and Bye bye to all of you.